Hey guys, Mike here. So another interesting day in the market to say the least. It was actually kind of quiet on the news front this morning, which I was really surprised about. But we will hit the S&P 500 chart to see, who won today, the bulls or the bears. Did we finally break the 200-day moving average and that kind of stuff? And what we got to look forward to on that. But I did run across some stuff. I always like to bring stuff to you guys that maybe no one else is bringing you to kind of look at this. And I always say to show you the conundrum we're in a way about this market, right? And so I'm seeing people talking about these different indicators that are 100% foolproof to tell you whether we bottomed or hadn't bottomed. And so now there's this big battle right now between two different indicators. Both have a 100% success rate in the history of the stock market, right? And so when that happens, because it's rare you have something that's 100%, you got to kind of at least take a look at it. And so I'm going to show you both of those, and you can give me your opinion what you think. And both of them, again, have supposedly been 100% right. So guess what that means? One of them is finally not going to be 100% right anymore, all right? And so we'll get to see which one that is. And then I'll go in and leave you with something to show you that, I trade a lot with Fidelity. And so they send out stuff to us, and I'll show you something I got from them, which is very interesting, and you can really use this like for the rest of your life. And I know I definitely will be using it for sure, and kind of changing up my investment strategy a little bit with it, because I am a data-driven person, and I do like to learn new things and become a better investor. But we're going to go into that, and I think you'll like it. I mean, it makes sense, but it also shows you why you're seeing this tug of war. Like people just they really don't know where we're at right now in a certain type of cycle I'm going to talk about, okay, or two different types of cycles. But I will say, for those who love their politicians, and I'll show you why I hate our politicians, and one reason I do is because of basically what they did to the blue-collar workers of this country. I mean, we used to be a manufacturing like superpower, right? And I saw this today come out, and I looked at it, and it just disgusted me as an American, because look over here to the left. You got North America, right, which is Canada, United States, Mexico, make up a whopping 18% of the world's manufacturing output, right? Look at over there in Asia to the right. These guys have managed to now be over half the world's manufacturing output. I mean, look at China, 4 trillion, Japan's 1 trillion, but I mean, just look at that. I mean, Europe's, they're at 22%. I have no idea what they used to be, but, Latin America's down there at 5%. But, we used to make a lot of stuff in this country years ago. But our politicians allowed and got bribed to allow all these companies to go make all the stuff overseas for cheaper, and ship it back into the country and obviously mark up the prices on us and stuff. So that sucks. And they've allowed us to become 70% services now. But yeah, I mean, I just saw that, and that's just a frustrating thing to look at and what's happened and stuff like that. But, let me know what you think and your opinion down there. But I know where I'm from in Alabama, there's plenty of factories that are still empty to this day. If you're in the Midwest, I assume you have plenty of factories, steel factories, stuff like that are completely still abandoned at this point in time. And, I mean, they're never coming back. Let's be real about that. But, I just want to show you that, get your opinion. But here's one of these indicators I was talking about. And this is pretty much all over the news. You can Google it. But this is 100%, according to Bloomberg, has a 100% track record, right? So whenever a bear market, and I've talked about this before, S&P 500 closes above the 50% fib retracement, it has marked the end of every single bear market. Well, of course, that happened last Friday, and I've told you guys about this. And just to show you, just in the 21st century, we'll look at it, but you can see the drops right there, the declines. And where the boxes are at, you'll see the price changes after 30 days, 60 days, and 90 days. And you can see it's mixed, right? After 30 days, back in 2002, it was negative. The other two were positive. 60 days, every one of them were positive. And then 90 days out, actually, 2 were negative. One was down 6.3%, and 1 was positive. Obviously, we have no idea right now where we're going to be on this one. But, that's one of them that's supposedly 100%. Here's the other one that's making its rounds. I've never heard of this one before. It's called the Rule of 20, and it is the sum of the year-over-year consumer price index, the CPI, and trailing P to E ratio. And every single time, it has to be below 20 to signal a market bottom, or in every other bear market we've had, it has done this, right? And so we ended the CPI at 8.5%, and then your trailing PDs around 20 times. So obviously that's about 28.5. You can see right here. And you can see how far away we are from being below 20. And I went through and I looked at the bottom of the years down there, and I looked at it and went back to the other chart who shows all the bear markets. And yeah, every single other time they have been either well below 20 or at least below 20. And it happened in 2020, we were below 20, right? And so interesting thing, but it amazes me how far away from that we actually are. And by the way, if you get anything out of this, please hit that like and subscribe button for me. I really appreciate it. And so one of these is going to end up being wrong, right? And understand that the 20, that 20 rule right there is kind of interesting because obviously CPI, we hope comes down, right? Year over year. And so it's 8.5. So let's say it gets down to 3 or 4, right? So that's 4 right there. That would put us around 23 on that list, which means the PDE would have to go back to around 16, 17. And really before this run up, we were at 18, right? So it's not that big a drop, you think, because CPI is going to make up most of that drop, you hope. Unless we're in some significant recession, then of course PDs obviously can drop off a cliff. But that right there, it's going to be interesting to see which one is wrong. I don't know right now. I mean, either going to be the 50 retracement or it's going to be this. And I don't know. We'll see. Let me know in the comments which one you're betting on, which one you think it's going to be. But one of them at least will lose their perfect record before this is over, okay? And so looking at the S&P, and then we'll get into the cycles I was talking about. And you can see right here, obviously, once we bounced off the 200, we've had 2 days down. I mean, it's been flat, really. But we're still above that 5-day moving average. And the reason why I look at that is because you can see usually when it does drop below or close below it, you can get a decent drop right there. And honestly, if you look, I mean, to me, drawing just a rectangle here, we're going to see this seems to be the battleground right here between the bulls and the bears right here. And the good news is for the bulls is even with all the economic data coming out, like the day we had employment come out, right? The employment market is still red hot, right? The claims were less than what they thought they were going to be. And so that just means people are still working, right? The jobs aren't being lost. And so it's still a red hot market, right? Which will keep the demand up, keep it strong, which will also hold inflation up because we're still buying. That's just the way it is. I don't think we're spending as much discretionary spending, but we're still spending enough and running those credit cards up like crazy to record levels. So, it's like, that's just where we're at on that. And so, tomorrow, don't forget, is monthly options are expiring. You tend to get a lot of crazy manipulations and swings sometimes on those days because it depends on, the market makers and everything. Wall Street sells you those options if you're buying them. So the last thing they want you to do is cash them in and make money, right? And so sometimes they'll manipulate the heck out of it to see where we end up. And I'm going to do a video on that a little more in depth because it does affect the market overall, right? And no matter whether you buy options or not, you're being affected by that. And so what I wanted to go into is I have accounts with Fidelity, and they send this out, and I'm going to start paying a lot more attention to this. But this is the business cycle update, right? So the key takeaways are the U.S. and other major economies remain in the mid-cycle phase of the business cycle, but an increasing number of indicators suggest that the late cycle, when economic growth slows, may be approaching. And if you look at this right here, this kind of shows you exactly where we're at and gives a little description. And if we look at this right here, you can see it's got the U.S. right in between, like mid to late right there, like starting the late. But if you listen to what the mid cycle is, it makes sense, right? So growth is peaking, credit growth is strong, profit growth peaks, policy is neutral, inventories and sales grow. And then if we come over here to late, you can see this sounds really familiar. What I feel like we're almost kind of starting to go into. Growth is moderating, credit's tightening, earnings under pressure. Earnings, yes, very much under pressure. Policy is contractionary, right? So obviously the Fed is tightening. Inventories grow and sales growth falls. Of course, inventories are growing for 2 reasons. One, maybe demand is slowing, but more importantly, we had the supply chain issues. We shut down the world, right? And you can see, look at where China's at. They already have China in a recession, right? So falling activity, credit dries up. This is all true, by the way. Profits decline. Policy eases, yes, because what are they talking about? They're going to do stimulus, right? And so that's absolutely the truth. And of course, inventories and sales fall. And so what that leads us into is this right here. And what we're talking about is the market cycle and the economic cycle, okay? And so the market cycle is always 3 to 6 months ahead of the economic cycle. But you see, this is where we came through ending last year, like from June to December, right, where you had this boom. And you had, large cap skyrocketing, commodities are going through the roof, right? You have right here, as you can see, easy money going on, right? And that's exactly what was happening, right? Euphoria, boom, you can see it right there. Rising real estate. Oh yeah, we've definitely had rising real estate. You know, that's been affected by inflation, which is throwing all this off, which I'll kind of talk about in a minute. And then you can see the slowdown. You know we're in it, right? What's happening? You get more yield on the short-term government bonds. People are buying into defensive sectors. High-quality assets, really, I mean, I hate to say it, but instead of high-quality assets, people are just buying into large cap stocks at this point in time, throwing things off completely. But you can see, what do we got? Rising interest rates, falling shares, falling resources. You know, what do you hear about? Scarcity of resources, scarcity of food, scarcity of oil, scarcity of everything else, right? And so then that would lead us into the recession, right? In the recession, they say, oh, we'll go ahead and load up on growth stocks because they've been beat down to the ground. And when we do hit the recovery, they're going to take off like it's rocket fuel, right? Corporate bonds. You can see right here, falling overseas reserves. More importantly, what do we not had, right? The rising unemployment right there. Hadn't had that at all. Matter of fact, it's still going down. Falling real estate. That is finally starting to happen because demand has fallen off. But the problem is, what do we have? Shortage of houses is keeping it propped up. So it's not falling like it should be at this point in time. And what have we had? Really just more of a technical recession, right? Because unemployment is so low. It's literally at historic lows right now and showing no signs of abating, as you saw this morning when the unemployment claims actually went down, not up like they were supposed to again. And so what we're looking for, we definitely know we're not in the recovery phase, right? It looks like because we have rising shares, but there's no falling interest rates. None of that's going on right now. And then to get a better view of this, we'll look at another graph, which maybe makes even more sense. And so as you can see what I'm talking about, here's stocks and the economy again, right? Sector rotation. Here's the market top. We know we saw that at the end of 22. Problem is, I think we saw it too early, but you saw, basic materials, energy, commodities, all skyrocketing. That's what was going on, right? And then, but here's the kicker, and I'm going to show you this. In late expansion, that's when you see people usually rotating to consumer staples. And then when we get in that early contraction, you'll start to see defensive industries, utilities in early contraction. Again, I'm going to show you this stuff. And then late contraction, that's when you'll see the financials and the consumer cyclicals right there, right? And then that's when we go right back into early expansion, and that's when you're going to see tech, services, construction, capital goods, rinse and repeat, right? So you see what's supposed to be getting bought up here in these phases, and that's where you're trying to figure out, okay, where are we at in this phase right here? And so that leads us into what are people buying, right? So what just hit an all-time new high today? Utilities, right? And so here are utilities being bought up like crazy. So that would lead us to believe we were in the early contraction phase, not late stage, or late contraction, like I think a lot of people thought we were in at this point in time. And you go over to right here, and you can see what else is going on. Healthcare. Healthcare is something that is starting to make a big comeback, and it's only about 12%, I think, from its all-time high, I believe. And then, of course, you got consumer staples. It's only 4% off an all-time high, so that's making a comeback. And as you can see the rotation right here, and you can see right here, this is 2022. You can see Q1, Q2, obviously things didn't look good for consumer staples or utilities, but now look at them. A lot of money flowing into those sectors right there. And you can see right here what's even scary about it to me is every single stock that's in the utility sector right now has reached its 200-day moving average. They're all above the 200-day moving average, excuse me. And so, it's good to know this, and trust me, I will be using this going forward and testing this theory out by having a portion of my long-term investment account go just for simple rotation, right? Simply to rotate, and I'll try to allow the hedge funds and all the big money to do the work for me, right? To drive these prices up of everything else, right? And so, it's one of those things. But what's curious is when you see defensive names going up, because that's what healthcare is, and consumer staples, that's defensive, right? It's not something that's going to be leading us into another bull market. That's something that usually starts a bull market. And so when you look at that, it's just curious to me to see that much money flowing into it. But the big thing is, the problem is when you shut down the world, and I heard somebody talking this yesterday, and it makes sense, and that's what made me start looking this stuff up, want to show you this, is that somebody said, look, it's great to have all these different indicators and rules and, business cycle and stock market cycle, but hadn't that all been thrown on its head and kind of mixed up because we did something we've never done before? We shut down the world, we shut down supply chains, then we open back up, and then the supply chains are a hot mess. China still hasn't fully opened up yet. They're still doing shutdowns across their country. And so, when that happens, it just kind of, it's almost like you're in multiple phases at once, right? Like some countries out there may be in this, some part of the market, and then other parts of the market are in a whole nother phase, right? And that's why people seem to be scrambling, like, which phase are we in? Because like a recession, right? Yes, we had 2 negative GDP quarters. So a lot of people used to say that is a recession. Now we're saying that, nope, that's not a recession. Okay, great. And why did we have that? And so, that's the thing when I say something like, man, this is the weirdest market I've ever seen, is because you can kind of follow that along, but now you can't really follow it as fast because we're dealing with so many issues, plus obviously inflation being where it's at, which we hadn't dealt with since the 70s, so not really in my lifetime. Then, that's a whole another issue, right? And so all that being put together, some of the stuff you look at and go, oh, that makes sense. It's following it perfectly. Then the other things you look at and go, wait a minute, we're buying tech now, right? But we're not in a recession. Why are we buying tech now? We're supposed to be up here. We shouldn't be buying tech right now. And so it's just, people are buying utilities here when they should be buying them here in this phase of the cycle. And it's just interesting, right? I mean, a lot of people, and I agree with them, are we in a technical recession? Sure. But with unemployment literally like record lows almost, I mean, when's the last time we've been at 3.5? I mean, I'm sure it's been a few times, but you don't hit 3.5 very often, okay? And you sure don't hit the kind of power that employees have now with wage growth, okay? And you don't have this much savings in people's accounts and this much equity built up in homes. And it's like all these firsts. I say this is the year of first, right? And so I agree with what somebody said today when they said, honestly, if we're going into recession, it's 2023. I think it's just got to be 2023, right? And who knows if it's going to be a small, big, whatever. Doesn't really matter. But if anything, take this, use it for the future. I know I certainly will, and I'll be doing more videos on it whenever we get back to, I guess, normalcy, and we're not having supply chain issues, and we can get chips for everything we need and all that fun stuff, right? And China fully opens up, okay? And so, that's what I'll be doing. But at least I like to show you stuff like this. And I don't know if anybody else talks about this on regular channels, but I like to, and learn new things and stuff because I like to be a better investor. So that's just me. So anyway, hope you guys got something out of it. Let me know what you're doing. Hit me up in the comments, and I'll see you guys later.